Hi, I'm Brett Swartz, founder of Capital Gains Tax Solutions, where we use the Deferred Sales Trust to help you escape feeling trapped by capital gains tax and the estate tax so you can create and preserve more wealth. So if you're like any of our ultra high net worth clients and you're faced with anything above $22 million and you're married, or $11 million and you're single and your total estate, you're facing a 40% estate tax on that amount. So the challenge is, how do I pay all of this? And or how do I get it outside of my taxable estate to save on this huge amount? So let's first walk through an example. So let's imagine you're married and you're worth $52 million and all $52 million is inside your taxable estate. Well, the first $22 million is exempt. The next $30 million is going to be hit with a 40% estate tax, which is $12 million. So the goal is to get all of the $52 million outside your taxable estate so you can defer it, okay? The challenge is, how do I actually do that in an efficient way? Well, the Deferred Sales Trust is the solution because we can sell assets today, move them outside your taxable estate upon the sale, therefore saving you all of that. Well, a common misconception with all of this has to do with the stepped up basis, and that's why we're going to cover capital gains tax versus the estate tax in this video. And so let's walk through that. And that $52 million example, sometimes it's perceived that, oh, I'll get a stepped up basis, therefore I'm going to be tax free. Well, yes, for capital gains tax, or your kids could be capital gains tax free, because capital gains tax is based upon what the basis is and based upon where you sell and how much of the gain that is. Although if you pass it to your heirs, they get what's called a stepped up basis, let's just say to that $52 million mark, and therefore they could sell that $52 million worth of assets collectively, and they could have zero capital gains tax. So that is true. However, that has nothing to do with the estate tax. And that's where the misconception happens. They still would have to pay anything that's left inside the taxable estate that, again, that was above that $22 million mark, or $11 million if you're single, 22 if you were married. So it's very important to look at not only your capital gains tax plan, but also your estate tax plan, and make sure that they coincide and that you're doing everything you can if you want to save in these taxes to get as much as you can outside of your taxable estate. So again, do not be confused with capital gains tax and a stepped up in basis accounting for or eliminating the estate tax. They are completely separate taxes, and it's important to have a plan in place and prepare before your estate passes, so that you can create and preserve more wealth, and so you can keep more wealth in your family. So here's what I want you to do. I want you to reach out to us, especially if you're facing any of this, for a one-on-one consultation call, free, no cost to you, and we can kind of walk through just a general framework to see if we can help you out. So you can actually go to this application right here to the right and just answer those questions. And again, that'll help us to maximize our time on the phone call. Thank you so much for watching this video, and we look forward to connecting with you soon.